Michael Avery with Classic Business on Classic 1027.
Well, it's been a rough first 7 months for emerging markets with a little over a week to go before we head into August. We've had concerns about global growth just compounded by uncertainty around global trade disputes. Every time US President Donald Trump seems to be opening his mouth, it's probably the worst we've seen as a start to the year, if we can even call it that, considering we're into almost the 8th month for emerging markets since 2013. We've seen PMIs rolled over. We've seen the slope of the US yield curve suggesting an increasing probability of a recession in the US over the next 12 months. So in English, normally yields on long-dated debt are higher than on shorter-dated ones, reflecting the opportunity cost of tying up money for a longer period of time, as well as the greater risk of default. And this curve has inverted ahead of every recession that we've seen in the US since the Great Depression. So the market's certainly worried about that over the weekend. So as an investor, these are indeed times to pay even closer attention to the tea leaves than normal, trade wars and our homegrown issues notwithstanding. So we've invited some tea leaf readers in chief to give us their view of the macros and the markets as we set up for the run into the year end. In studio, I've got Dr. Adrian Saville, CEO of Canada Asset Managers. Adrian, great to see you again.
Thank you, Michael. Good to be with you.
And on the line, Standard Chief Economist Kevin Lings. Kevin.
Hi. Good evening, Michael.
And Claire Rensker, the Chief Investment Officer at 274 Investment Managers. Claire, thanks for joining us.
Thanks, Michael. Great to be here.
Now, Kevin, kick us off. I mean, from the macro perspective, there's no shying away from the bad news. There is bad news out there. We've seen PMIs, as I said, haven't done well. Oil price up a lot. The probability of a US recession has been picking up. And if you add in, we're seeing increasing corporate defaults in China, the prospects of a trade war, I think one could craft a fairly bearish view. Where do you sit from the broad perspective on where we lie globally?
Michael, I would agree with that in terms of sentiment. It has deteriorated this year. I think the IMF kept their world growth rate as a number unchanged, but they spent a lot of time last week when they brought out their update just highlighting some of the risks and the fragility to the current global growth rate. And I think those risks are now more than just the US raising interest rates, which was pretty much the concern towards the end of last year. Now the risks very much include a potential escalation in trade protection. We have to say that's not just between the United States and China. It can start to include Europe. Obviously, we've also got Brexit, which seems a fairly messy process at this stage, and that I suspect is going to undermine growth out of the UK, and it can't be exactly great for Europe. And then, as you mentioned, some of the emerging markets are not doing quite as well as you perhaps would have anticipated. Obviously, China's growth rate is still good, but in effect, slowing down to some extent. I think India is doing especially well, but when I look at Brazil and Russia, they're kind of messy. Obviously, South Africa being part of the BRICS and the BRICS summit, we're not doing particularly well. So there are a whole range of factors, I would argue, that are starting to weigh on sentiment in the global economy. We're far away from saying that we are going definitely into a recession. At this stage, we would say, in all probability, we've got a slowdown to world growth that will come about next year. I'm also not necessarily convinced that the US will go from where it is now automatically into a recession, but clearly the risks are building up. And the problem, I guess, for South Africa is that we are only trying to get going at exactly the same time that the world economy is losing momentum, and the timing of that is not ideal. We tend to do well when the world's doing well. So we're a little bit behind the curve, probably about 5 years.
Oh, gee, that doesn't paint a very encouraging picture, Kevin, but one I tend to agree with. And Adrian, that would be so typically South African for us to get our act together around about just after the general election next year, when the world economy really starts slowing down in a big way. How are you reading things from a broad perspective?
I think Kevin's comments I would agree with. I think they're on the money. Perhaps to add a couple of observations, Kevin makes reference to the IMF. By its nature, the IMF tends to be sort of more glass half full and cheery about prospects. So even in glum times, the IMF tends to point to a better picture. And I would shave about 0.5% off what they think the world economy is going to do.
So from 3.9 to about 3.5.
Somewhere around that, to me, makes more sense in the current environment. And in saying that, it's not just the US yield curve that is pointing to inversion. The UK looks like that. Europe looks like that. So there's a flattening of the yield curves pointing to harder times more broadly. And in the emerging markets, it is without question India that's doing the running. China will tell you the number rather than do the number. And it is interesting that although a lot of the commodity producers have come into much better shape because of more buoyant prices, it remains the case that Brazil, Russia, and certainly South Africa, as a commodity-based economy with a weak currency, continues to struggle.
And that is the truth of it as we head into that BRICS summit. It still amazes me that we managed to find our way into the BRICS, considering how small the South African economy is in the grand scheme of things. Obviously, we play an increasingly strategic role for China as it seeks to exert its influence in Africa. And O'Neill, Jim O'Neill, I think it is, who first coined the BRICS acronym, quoted by Ferial Haffajee in the paper over the weekend, saying that we will be that bridgehead or that bulkhead for China and its Belt and Road strategy into Africa. I still don't see how we play that role from a geographic perspective, but I certainly can see how we play that in terms of regional African politics. But as we look to build a case here for investors, Claire, the big disconnect, I think, for many people has been the disconnect between emerging markets and developed markets. My market commentator earlier today was saying that we're probably seeing opportunity in the EM MSCI, if you're looking for a tracker, to start perhaps even taking a position in emerging markets, because that discount is so vast, and it's not like we're looking at another 1998 like emerging market crash. Would you go along with that?
Yeah, absolutely. So, I think emerging markets as a whole have sold off significantly off the back of more uncertainty about the global growth environment. But these things always tend to overreact in the short term, and potentially EM has sold off more than what is justified. The reality is, even if growth is slowing worldwide, and you can shave off some of what the IMF is saying in terms of their forecast, we still are seeing growth. And we speak about a flattening yield curve in the US in particular, and how that potentially signals an upcoming recession. But what has happened is that we've seen the short end of the curve re-rate very rapidly, and we've yet to see movement in the longer end of the curve. So it's not necessarily all as bleak as the picture that has painted, but there's no doubt we are into a difficult time because of this. There is just so much uncertainty around trade wars and how that is going to impact emerging markets, because at the end of the day, we really are governed by what goes on in the world and the US in particular. And we really are very uncertain as to what's going to play out. And as investors feel that uncertainty, they move to safer havens, and it's been coupled with the potential rising, likelihood of rates normalizing back in the US, making that a more attractive opportunity. So I definitely say that EM has begun to look much more attractive.
And Kevin, to bring you into the SA Inc. component of emerging markets, There was obviously the huge rally post the ANC's elective conference in December. It seems to be Ramaphosa more than anything else at the moment, not a Rama recovery. But you look at the drivers in the South African market, that first quarter GDP print was really awful. But if a lot of the research I've seen has said that we tend to get it wrong in the first quarter more than most other countries. In fact, over the last 5 years, our first quarter growth rates have been 200 basis points below the average of the other quarters. What are you expecting for the second quarter?
Michael, at this stage we are optimistic that we'll get a small positive outcome. So that we kind of avoid a technical recession. By small positive, I'm looking at 0.5% growth. We have seen, April wasn't great in terms of manufacturing, retail, the mining data, but May data did improve, and early indications for June from some of the feedback we're getting from the companies we look at is also reasonably encouraging. So my sense is that we can avoid a return to recession conditions, only just. And then the question is, can we get some momentum building into the second half of the year? I think you're right that typically the first half tends to be tougher than the second half if you're going to kind of look at the averages. And perhaps there is some momentum that we can build up into the second half of the year in terms of keeping inflation reasonably under control, a little bit of consumer spending because real incomes are positive. Hopefully we get still some traction in terms of our trade performance, but none of the factors that you look at are that convincing, right? So it's not as if you can point to a particular indicator and say, wow, that component of the economy is really strong. So it's hard to characterize where the uplift comes from, a meaningful uplift. By then I mean we start to approach 2.5-3% growth. So it's all sort of scratching around for a little bit of performance, and then hope that it gets better into next year and beyond the election. But we still are not at a point where confidence levels are high, where companies are thinking about expanding. Most of the companies I talk to are still talking cost-cutting and really scaling back on any expansion plans. So it's difficult to see where the growth is going to come from.
There's growth in irregular expenditure. Just have a look at Eskom's balance sheet, Kevin. There's a growth industry in South Africa at the moment. Adrian, I do look at some interesting bits of economic information here around the consumer that makes me slightly encouraged. The first quarter TransUnion Credit Health Index at the highest level since 2011. Now, maybe I'm really clutching at straws here, but there is a theme or a story that's being built around the consumer that's been under pressure because of the VAT increase. I think the retailers have actually absorbed a lot of that, and the fuel price hikes. But the consumer balance sheet is looking better. The consumer has deleveraged because there's no confidence. Could we see a big uptick into the second half of the year for the consumer-facing sectors of South Africa Inc.?
I think sort of low and stable interest rates have been part of that balance sheet rebuild, along with much tamer inflation than has historically been the case, along with, Kevin made reference to this, improvements in real per capita, real wages rather. So I think those translate into a better landscape for the consumer, and given that the consumption is the single biggest component of GDP of the economy, of course, if you've got a healthier consumer, then mathematically that translates into a better bottom line number for economic growth in 2018. My complaint or concern with consumption spending is that it's not sustainable. And South Africa is overwhelmingly import-oriented in the consumption basket, so it doesn't really stimulate the production side of the economy. And consumption, of course, is the opposite of saving, and saving is the fuel of investment. So although consumption might sort of light up the eyes of near-term focused analysts, to me, it's That's not the thing that moves the needle. What we really need to see is an improvement in investment behavior out of the South African economy, which will be fueled by saving.
And as Kevin referred to, companies are not investing at the moment. Their cost-cutting, gross fixed capital formation is still at lows and has struggled to recover from that big dip that we saw in 2007. We saw a massive inversion there. Claire, when you're trying to build this into a strategy for the year end and an equity strategy, what are you doing over at 27 for investment managers? Because South African equities are cheap. You look at the median PE of the Aussie, it's near the lowest level since 2012.
Yeah, absolutely. And I think, a lot of investors have become fairly disillusioned. If you look at what equity markets have given you over 3 years, it's barely 5% annualized, which is a very low return environment and very discouraging for investment and savers. But there's always, when people are fearful, there are always opportunities. And what we've seen is that there's far more opportunity in what you can pick up for reasonable prices. And any investment strategy should be built around what you pay for the stocks that go into your portfolio. So we are quite happy as a multi-manager selecting asset managers that our managers are seeing far more opportunity in much higher quality stocks across the spectrum. There's no more having to dig for value in businesses that are really not great at generating returns for shareholders, or in how they spend their capital. So far more opportunities and a much diverser opportunity set, which allows us to blend managers together who are picking up great opportunities at really reasonable prices. But the most important thing is that investors need to bear in mind the time horizon. If you're investing in an equity market, you can't have a 1, 2, 3 year time horizon. You really need to take a longer term view, because some of these things do take a while to unlock.
Lastly, Adrian, you look at bonds are quite cheap at the moment as well. And if you're looking out 3 to 5 years and building a strategy for that sort of time horizon, where do you see value at the moment?
I think to add to Claire's point, if you've got a 3-5 year horizon, in South Africa, certainly the mid-sized and smaller equities look particularly interesting, very attractive value. Government bonds further out are attractive. And I think both Claire and Kevin made reference to China. The economy is in reasonable shape. There's concern around credit extension in China. But the valuations are compelling. Single-digit price earnings and individual names like Alibaba make for particularly interesting reading.
Well, that's unfortunately all the time we have for tonight. It does make for a fraught near-term strategic market for investors. I think picking stocks or picking winners right now is increasingly difficult. But when you look over in China, there are some fantastic names with huge growth potential going for a song. So that is one market that I would agree with you, Adrian, I'll be looking at long and hard. That was Dr. Adrian Saville, CEO of Cannon Asset Managers, joined by Standard Chief Economist Kevin Lings and Claire Renske, Chief Investment Officer at 27 for Investment Managers.